Well, uh, hopefully you know that we're an all-volunteer organization. Uh, it's the largest network in the country. And no matter what stage your business, SCORE has a mentor for you or business education webinars for you. We also, it's not well known, but we have a significant practice for nonprofits, and we have a team that specializes in working with nonprofits. All you need to do is go to our website and request a mentor, and we'd be pleased to work with you as long as you want to get value out of it. It could be one session, it could be hundreds of sessions. It just depends on the value you get out of our services. Just a little bit of review. Last year, we helped create over 150,000 jobs and start over 31,000 businesses. And perhaps most important, and this is nationwide, 65% of our clients are women, 46% minorities. And if anything, this is representative in Northeastern Ohio. We may well have more than half our clients as minorities. Also proud of about 10% veterans. And so SCORE is for all, whether you're a minority, a Hispanic, a Black, any kind of minority. We have translation services for many, many different languages. As I said, veteran entrepreneurs and women entrepreneurs are very, very common in our practice. We do sign a code of ethics, so your information is secure with us. It's confidential, it's protected by the government, and we cannot in any way, shape, or form benefit from your information and stay a member of SCORE. Finally, just to say, if you want to find a mentor or you want to work with us as a volunteer, please go to our website, www.score.org. And that should get you, all you have to do is put in your zip code and we'll get back to you. So I will, I'm not going to stop sharing yet. I'm going to introduce Dave. He's over 22 years, he's been involved with credit unions, nonprofit banking, and he's currently CEO of Comstar out of Elyria, Ohio. I'm proud to say I've sent a number of clients there. Never heard any complaints, and he's wonderful to work with, and he's also one of the sponsors of SCORE that allows us to give all our services free to you clients. So I'll stop sharing and let Dave take over.
All right, I'll share my screen here in just a second, and we'll get started. Thank you for attending Behind the Lending Curtain. This is part 2. If you did not get a chance to see part 1, that's okay. Part 1 is out there. SCORE has it on their YouTube channel. You can look at last session that we did yesterday, and we're going to do part 2. I always tell people that when I do the Behind the Lending Curtain series, I kind of tailor it to the amount of time that we have, and I want to be respectful of people's time. So if you have questions, please put it in the chat, or you'll get my email address during the presentation. You can email me direct, and either myself or my team will answer those questions as quick as possible. Before we get started, Bob and I, we were talking kind of just before the session about, talking about just the quick idea of what a credit union is. And there's a lot of people that don't know that credit unions are basically the non-for-profit, member-owned cooperative version of banking. So, and some credit unions, including Comstar, we have business services. We do business accounts, we do business lending, and it's an honor really to be able to help SCORE out as another not-for-profit and volunteer and teach this class and try and take a little bit of the mystery out of loan applications and what happens during the loan approval or denial process, and then what happens to get to funding of your loan, and then life a little bit after funding of your loan. So, every financial institution has their place. There are big corporate corporate banks that you hear about, the city banks of the world and those kinds of things, people that deal with Ford Motor Company or, the big, huge credit unions aren't really in that space. And then there's regional banks that you hear of, the kind of the PNCs, Huntingtons of the world, those kinds of things. And they're all in the for-profit model. And then there's the credit union model. And the credit union model is leadership is derived from the membership. They have a lot of local flavor. They're not for profit, but we do offer a lot of the same things that other banks do, including business lending and business services. So you've never dealt with a credit union before. I would encourage you to just do some research and find a good credit union in your area. And it happens to be us. That'd be great. But one thing about credit unions is the vast majority of credit unions leaderships and decision-making happen inside the building. We don't have an office in New York or an office in Pennsylvania or somewhere where I have to wait for decisions to come back and forth from. We try and have our impact in the local communities. So that's kind of my plug for credit unions and working with credit unions. All right, so I'm going to share my screen here. See if I get this right.
Yep.
Okay, can everybody see that there? Excellent. So, too far. Here we go. So, part two. So in part one, we talked a little bit about the application process, a little bit about how your business loan officer will look at an application process, look at a packet. We talked a little bit about underwriting and kind of what their function is, and also the business loan committee and how they are the liaisons between the loan officers and underwriting and trying to get to funding. And so great discussions about risk, how to take risk out of business loan applications and why that's good for the borrower, why that's good for the lender. And we talked a little bit about terms, conditions, covenants, and amortization. So if you have questions on that stuff, please let me know. And also, we're going to be going through part two, kind of a little bit higher level. And so if I talk too fast, please raise your hand or ask a question, and we'll go from there. Okay, so first thing about part two is one thing I mentioned yesterday is the commitment letter. Now, the commitment letter is a very important document. I talked yesterday about how sometimes I hear borrowers say, well, I've gotten this pre-approval. Can you match it? Or here's what they said they would do for me. One thing that I always ask when I hear that is I ask for their signed commitment letter. Now, the commitment letter is kind of the agreement between the lender or the borrower at that point in time, anticipating funding the loan. So what are some of the things that can go in a commitment letter? This is not a comprehensive list for all financial institutions, but the more details in your commitment letter, the better. And you should sign it once you agree to it, and your lender should sign it once they agree to it. So first of all, the term and the amortization. How long is the term of the loan? And remember, the term protects against market fluctuations. And then how long is the amortization? That protects the borrower's cash flow during this initial loan period. All right. So the next thing is conditions. Are there conditions of the loan? So, for example, there's a big difference between a condition and a covenant. And a condition is, yes, I will do this. So, for example, a financial institution might say, hey, we would like you to bring over your business checking account, or we might want you to put 3 months worth of this business loan payment in a savings account with us. Okay, that's a condition. And they can put multiples if you agree to them in the commitment letter. But then they also will tell you what the covenants would be. And the covenants are really serious because the covenants are, you have to do this or you cannot do this. Or if you do or don't, you will be in default of the loan. So let me give you an example. Let's say, for example, you buy a business and your business decides that it's went to a trade show and now it wants to buy some $200,000 piece of equipment. There may be a covenant in your loan documents that say any investment in capital above a certain dollar threshold, maybe 20, 25,000, whatever it is, you need to get a review that with your loan officer. Now, you might think to yourself, well, why should I do that? This is my business and I want to run it a certain way. Well, you have to remember that when we gave you terms and amortization and we risk rated your loan request, we gave it a certain risk profile. And that risk profile was dependent on your debt service coverage ratios that we talked about yesterday. So if all of a sudden, 6 months later, you put $250,000 worth of new equipment on your books, that is definitely going to affect your debt service coverage ratio that was underwritten and part of the approval process. So if you don't do that, and then you get to a review of your loan and your debt service ratio is now extremely underwater because you didn't talk through it, then your financial institution might say, hey, you're in default of the agreement. So you have to understand the difference between conditions and covenants when you get to the loan documents, and that should be spelled out in your commitment letter. Also in there is I like to know what kind of third parties are going to be involved in the process from the time I sign the letter to when I get funding. So for example, do I have to have someone appraise a vehicle or appraise a piece of property or a piece of equipment? Do I need a specialist with environmental give me an environmental report? Am I buying something that may have been, let's say, a gas station at some point that might have underground storage tanks, or maybe a dry cleaning facility that has contamination in the ground from chemicals, those kinds of things? What kind of third parties are going to be involved in making sure that we can still get to funding? Fee schedules. Fee schedules should never be a surprise. So did we have to do freedom of information requests for, environmental studies? What is our environmental technician going to charge us? What is the person who's going to appraise the real estate? What does that look like? How much is it going to cost if we're doing a construction project for all of the draws that we're going to do during construction? Those kinds of things. So all of those fee schedules should be part of the commitment letter. You should have an idea like this. Okay, this is what's going to happen. And then expiration dates. For a very long time, from probably 2008 to 2020, something like that, the Federal Reserve didn't do too much. And so the Fed rates and the prime rate didn't really move at all for a very, very long period of time. But now you see extreme volatility in pricing when it comes to cost of funds, cost to borrow, the Federal Reserve's attitude about rate cuts or not rate cuts. And so there will be, or should be, some expiration date that you should be aware of that says, hey, this is our commitment, and we want you to accept this commitment in X amount of days. And then also we have an expectation that we will get to funding within X amount of days. And so if you get past that expiration date, you may need to renew that commitment letter. And then of course, signature expectations. If you have owners, even if they're investors, but they have a 20% stake in your business or better, they may have to sign for that loan too. So there should be the expectation of who the signers are going to be. on that commitment letter. Now, one thing about the commitment letter is the borrower and the loan officer are going to have a conversation about everything that's in there. And like we talked about yesterday, all of the things that are discussed, and this is what I love about business lending, are negotiable. Okay. So it has to be for mutual benefit. So it has to be good for the borrower, right? Because we want the business to succeed, but then it also has to protect the organization that's lending the money. So that's why you have this negotiation of terms that go into the commitment letter. And once those are agreed, then you also have to make sure that you are in agreement with the conditions and the covenants, because those are a little bit, those can get a little bit serious if there is default risk when it comes to, your renewal period, which we're going to talk about a little bit later. And when does a commitment letter need to be revised? We talked a little bit about expiration dates, and also were there changes in what we agreed on in the terms and the conditions and covenants. Okay, so based on that, it's either a yes, we anticipate it, or it's a no. Well, we can't, but we're going to negotiate these other things. All right, so those are going to be conversations between you and whoever your loan officer is. Oh, there we go. Sorry about that. Okay, so if you got a yes, there's still a little bit of work to do. I know it seems like we've been talking about, well, it's yes for now, it's yes for now, it's yes for now, and it's kind of like watching the Olympics, and people are doing the they jump over the not the pole vault. I can't remember what those things are called. You got like 4 or 5 of them to jump over, and sometimes people run them over and that kind of thing. But
Hurdles.
yes, hurdles. Thank you. I couldn't think of it. It escaped me. So sometimes this process feels a little bit like that. All right. So first of all, what kind of lien searches do we need to do? So, for example, let's say you are buying a piece of equipment. Well, we want to make sure, if it's been titled before, that there'll be a clean transfer of that title, and if there's a payoff on that piece of equipment, that gets settled. If it's a piece of real estate, is there a title company involved? Do they have to make sure there's no other people that have claim to that property? Those kinds of things. Flood certifications. I know that's been a popular topic lately, especially with the flooding that's happened internally in the United States, outside of the coastal areas. Surveys very interesting. There was a deal that we looked at where it was 2 pieces of property, two commercial buildings side by side, and they had what I would just call a common driveway. Okay, so both business owners thought that, well, I own kind of half this driveway and the other owner owns this other half of the driveway. But when they did the survey, they actually realized that one business owned all of the driveway and the other business was basically given permission and easement of sorts to use it, right? Because that was the only access to the building. But that came out in the survey, and then there had to be agreement between the owners and about parceling off or having a filed easement for half of that driveway, because there would be way too much risk to the borrower and to the lender if that wasn't filed. If one said, hey, you can't use this entrance anymore, they would have had no access for people coming to their business. So surveys are important when it comes to real estate, because sometimes you'll find weird stuff like that pops up. And then once those appraisals come in, how do we feel about the value of the appraisals? A lot of times lenders will lend against collateral value. And if it's a real estate transaction and the appraisal meets those ratio requirements or does not, then sometimes there's further discussions, including reappraisals if appropriate. And sometimes we do request reappraisals with data about comparable sales of those kinds of businesses, that kind of thing. That is something that financial institutions can do if they feel it. The first one was way off the mark. Documents package. A documents package will be ordered right before we're getting ready to get to funding. And as on our side of the fence, we always review those loan docs because those loan docs have a lot of legal jargon in them, and they're many, many pages long. And I want to make sure that those are correct from our standpoint, that we agree, and then also the borrower has agreed to everything that's in those documents. And then if it's a real estate transaction, typically whoever is going to be handling some of the title work and the distributions will give a clear to close that will be communicated with the borrower. And then the timely closing is scheduled. Sometimes this gets interesting in business lending because some of the signers don't necessarily live in the same place as the business. So there are tools available, especially now with digital signing. Some places require wet, inked signatures, and so there's mobile notaries. There's title companies that we could use in other locations, even other states, that will help schedule a closing to make sure that the closing goes in the correct sequence. And so you have to just to be aware of what our calendars look like for that. So when we get to closing day is a very exciting day. People are excited to either start a business, expand their business, refinance for better terms of their business. And so I have some basic do's and don'ts that I would like to share. So first off, I would like our borrowers to have a very clear understanding of the closing documents. I'm a big fan of trust being formed by transparency. So there should be nothing in those documents that is a surprise or, hey, I didn't quite think it was this. All of those things should be very transparent prior to that. Understanding disbursements and fees. Sometimes the money isn't going to you directly. Sometimes there might be a payoff involved, or there might be, hey, we're going to send a check to the truck company to get the truck, or those kinds of things. Sometimes all of the money doesn't just go into your business account and then you write checks from there. It doesn't always work that way. So different financial institutions have different expectations to how disbursements will work. And then also the fees. We talked earlier about, who's responsible for paying the fees, those kinds of things. We want to make sure as a lender, all those things are done correctly so that someone doesn't say, hey, I didn't get my money, and so now I'm going to put a security or a lien position on that collateral. Notary schedules in the sequence, just kind of respect that schedule. They've got a very important thing to do, and they try and keep your schedule and their schedule consistent and convenient. Who needs to be in the room? That's basically signing. And then the no right of rescission. This is a very popular question. There are a lot of protections on the consumer side. The CFPB has a lot of protections built in for consumer lending. Those are not the same protections in business lending. So if you sign it, it's yours. All right, congratulations. So it's not like you say, a day or two later, I changed my mind. I have, these rights as a consumer borrower. It's different. Business lending is different than that. But if you're having second thoughts when you get into the room, then I hope that's just kind of nervous butterflies and not something more dire than that. So one of the things that I appreciate as a lender and my team appreciates is let's not be late to the closing. This did happen to me once, which was not a great thing. I got a phone call from a title company that was handling a commercial real estate, and all of a sudden the borrower wanted to try and renegotiate the terms with the title company. So I had to go and then that wasn't great. Because now all of a sudden you're kind of starting the process all over again. And that's not really something a lot of people want to do after the time and investment they have in what they've done currently. The renegotiation of covenants and conditions. That is just not something that a financial institution is going to do at closing. Those things should all be spelled out in a signed commitment letter or a revised commitment letter. Never at closing, never in the closing documents. And then don't forget to bring all the signers. Sometimes I've been speaking about the sequence of events and how certain things need to transfer, either titles, those collateral, those kinds of things. So bring all the signers, make sure that they're on time, and make sure we can get all the sequence together. All right. Closing day should be a great day for everybody because it's kind of the next chapter of your business. And then the Benjamins, right? All right, you get the money. You might not get all the money depending on how it's dispersed, but there you go. Get after it. So there used to be this term that I hear every once in a while called the honeymoon period. And I guess that kind of goes toward, well, borrowers and lenders are all nice to each other until after funding. Then all of a sudden, you don't hear much from them, or we like to consider ourselves a partner in the entire lending process, which is not just up to closing day. So we like to be a partner. We don't want to be a pest. We want you to run your business. We want you to be successful. We're here for consulting and just talking about where things are with your business. But there are reviews and renewals that will be on your horizon. So don't forget about your business lender and don't forget about the process that it took to get the funding, because there's more work to do after funding. So first off, let's talk about annual reviews. So some financial institutions have a different threshold for when they require an annual review. So let's say you borrow $100,000 or $50,000, and your lender says, well, okay, because of that dollar figure, we are not going to look at all of your financial statements and all those kinds of things every year to make sure that you're not more of a risk. However, if you start getting into loan balances that are, let's say, $250,000 and above, you can expect most lenders to ask you for lots of stuff similar to your loan application, just to review how things have been since you used this money that you borrowed to either improve your business or expand your business, those kinds of things. If you do have covenants or conditions in your loan documents, and sometimes you will not, sometimes there will be none of those. If you do have those, though, I would expect a review to make sure that everyone's acting the way that they promised they would. Insurance and financials is very frustrating to chase down. Does your business still have insurance? Another interesting part about insurance is some financial institutions require a thing called a key life policy. So let's say, for example, you borrowed $1 million and you're the only person who engineered this widget and who knows how to make it, knows what it's made from, keeps it super secret because, it's a very niche product. Some financial institutions might require that you, as the owner, have a separate insurance policy that will protect that loan balance if you have some crazy skiing accident or something like that, and you're the only person that has kind of the keys to the castle, so to speak. So don't be surprised if there's a request for that, depending on the circumstances of the loan. Also, financials. I will tell you that what I like to see is an agreement signed as part of the commitment letter or at closing where you allow your accounting firm to disclose, once they're done with your financial review, a copy to the lender. If you have a certain type of loan that requires annual financials as a review, it's very easy for them to just be like, okay, we're done. And we email it to the borrower, and we also email it to the lender. So then we don't have to ask you, hey, can you get your accounting to send this to us? Or can you get it from them and then send it to us? If they could just do that automatically, that's very efficient. Some loans will require that. Payment history, very important. It's not only the review that we do to look to see that you can still afford to pay, but you're just paying as agreed, right? SBA reporting, we talked yesterday about the effect of SBA and how it reduces risk for the lender. And so we get monthly reports from the SBA about, we talk about payments and those kinds of things. So we have reporting to them. And then participant reporting. We talked yesterday about concentration risk and also the size of a loan that might need another financial institution to invest in that loan. So they are going to want to know from us, if we're the lead lender, they're going to want to know from us, hey, how's XYZ doing? And so we have to give them the information from some of these reviews so that they say, yeah, we agree. We want to keep investing in this deal. And then preparing for term maturity. This is something that, time has a tendency to just kind of sneak up on people. I mean, look at the holidays. What are we, like 10 days out now? 14 days out, something like that, before Christmas. Business loans, when you've negotiated your term and your amortization, you should always kind of keep a 12-month calendar to when that first term matures, right? Because there's certain strategies to prepare for that. So this slide says 6 months. I think that's appropriate. I put a lot of stuff in my Outlook calendar, like, hey, don't forget, anniversaries, and you got to do this, and sometimes I put, contracts, people that we do business with. So, and you have to evaluate, right, if you're going to renew that contract and what other options are out there and all those kinds of things. So about 12 months, 6 months out, I would do the same thing for your business loan. The first thing I always ask borrowers, if we do a review getting close to the end of the term, is let's have a conversation, an honest self-assessment of the performance and the relationship with the lender. One thing that I like about that is I am not immune to criticism, right? They might say, hey, look, I don't want you I don't want you to not talk to me quarterly, or, we've only talked once a year. That's not enough. Oh, okay. I think that it's okay to take criticism like that as a lender. Also, they might say, hey, look, market conditions are different. Interest rates are lower. What can we do? All those kinds of things. Or also on the other side of the coin, I might have to say to the borrower, hey, look, 12 months, 4 of those months, you were late. I had to call you 2-3 times to get payment. What's going on, those kinds of things. So just that kind of honest self-assessment, just to see where everybody's at. And then get market smart. There are, circumstances that make cost of funds go up and go down. All right. And you should be able to have conversation with your loan officer about how your business fits into those shifts in the market, and whether or not cost of funds are up, cost of funds are down. Does it make sense to, renew early? Those kinds of things. Is it not? Does it not make sense? So be aware of those things as a borrower. And then also, kind of talking about whatever your business model is, you have to be prepared for certain things that financial institutions may ask you for. So, for example, if loan to value, if it drops, so let's say, for example, you buy a piece of equipment and that piece of equipment was supposed to be good for 7 to 10 years. But then some new technology came out in the market, and now what you have might only be valid in the market for the next 12 to 24 months, and it's going to, it's going to be superseded by something else. Well, clearly that's going to change the risk in the loan. So we have to talk about what that looks like. And let's say your business owns a bunch of things, like a landscaping business, right? A bunch of tools, equipment. Some of it has VIN numbers. Some of it is what we call UCC filed, where the lender gets to protect itself with all the assets of the business, not just titled property or titled equipment, that kind of thing. Well, did I sell that rototiller and now I have a different one? Do I need to adjust that UCC filing? Those kinds of things. And then, are there cash flow shortages? Did our business not perform the way that we thought it would? And then, through mentoring with SCORE or the SBDC and talking with a lender, how do we account for that? And sometimes you have to bring cash to the table. That's why it's important to start having these conversations 6 months to 12 years out. If your collateral is all of a sudden worth 50% of what we thought it was a year ago, a lender may ask you to make up the difference in cash and equity and say, okay, we need you to kind of buy this down, so to speak. So just be prepared for those conversations. I'm not trying to say that annual reviews are scary and dire. Sometimes it's just the opposite. Wow, things are going great. Do you need some more money? That kind of thing. Do you want to expand faster? Do you want, those kinds of things? But also, the other side does happen on occasion. So you just have to be prepared for those. And then, will the loan ever end? I love this discussion. And I think this is really speaks to kind of the heart of credit unions. There are many financial institutions that never want the loan to end. They do the initial term and then they renew it for another, let's say, 5-year term, and then another 5-year term, and another 5-year term, and another 5-year term. And the amortization never ends, which is good for the cash flow piece. But credit unions, our credit union anyway, we kind of look at it as what is the best advantage to the owner. And the best advantage to the owner is maybe after the first loan term. When we get to the second one, we say, well, how would it affect you if you did another term, but at the end of that term, it was completely paid off? There's no more amortization. It's yours, right? And you can do with it unencumbered by the financial institution. So we will look at those term out scenarios after the first term, which I think is an advantage versus some financial institutions that just want to continue to churn it over and over and over again. So let's see. Another piece, and I don't want this to be scary. Another piece that you just have to be aware of is the fact that the lender is under no obligation to renew that loan. So it's very important to be a good borrower, good communicator, good with documentation, pays as agreed. Those are all huge, huge pluses. However, sometimes financial institutions have to say that they're not going to renew the loan at the end of your term. And one of the reasons that might happen is, let's say you bought a piece of investment property. And let's say for an entire year, that financial institution only lent money for investment real estate. And it got to the point where they had so much money in their bucket of investment real estate that they just can't do anymore, right? So they might say, hey, look, I'm sorry. I know you've been a great borrower, but we cannot renew this loan because I have no money available in that bucket of lending. That does happen on occasion. Now, sometimes, especially with credit unions being cooperatives, we know other credit unions that do business lending, and sometimes they say, hey, we have a real estate deal that's going to renew. Could you take a look at it, because we don't have any more room for that? And so, we do that and try and help the borrower out. Participant withdrawal. One thing about that you see in the news a lot is mergers, consolidations in the banking industry, in the credit union industry also, but not nearly at the same pace. Well, those acquiring financial institutions may have a different business model. And that business model might say, hey, look, we want to have our own loans. We don't want to participate in loans with other financial institutions. We're getting out of that business. So they might look at a renewal and tell the financial institution, I'm sorry, I can't invest in that other half of that deal. That does happen on occasion. Market forces, you just never know, which way the winds are going to blow. Sometimes, reputation risk, we touched on a little bit about, some groups may, let's say, for example, you owned a shopping center and you had 4 tenants in your shopping center and you want to keep that as full as possible. Okay. And in Ohio, a year later, you had a vacancy and you filled it with a marijuana dispensary. All right. Now, however you feel about it morally, some financial institutions may say that from a reputation risk standpoint, that all of a sudden that shopping center is not something that they would desire to be known as a lender for because of the business that's in the shopping center. They might say, look, we can't renew that with that tenant. Ohio, is kind of, I'm not exactly sure where they're going to stand in 2025 as far as medicinal, recreational, all the licensing, all those kinds of things. But that might be something that pops up. And then rate opportunities. If I know that rates are going to be going up, or I have a pretty good idea that rates are going to be going up, if I have a 5-year term and maybe I'm in my 3rd or 4th year, I might say, hey, let's renew now. Let's renew early so I can lock in the advantage of the rate before it goes up. And then, the opposite is true too. If rates are going down and you think they've hit the floor, maybe you might say, hey, now's, I want to negotiate maybe early to capitalize on lower rate, lower payment, better cash flow, those kinds of things. So the rate opportunity for you is also the same as the rate opportunity for the financial institution. So what I mean by that is, we give out loans and loans pay off. And then we might say, well, we're paying off loans that were at 3%. But now, because of the rate opportunities, we're going to be lending money out at 6%, right? Because the Fed rate is higher and the prime is higher, those kinds of things. And so they might say, well, we're going to put more into business lending because we can capitalize on rates. And then the opposite is true. If rates are going down, they might not want to renew because they don't want to put out loans at less than the percentage that you have gotten. It's kind of a dance. Rates are kind of a dance with what they can borrow money for, what they can lend money for. And so they evaluate their rate opportunities just as much as you should be evaluating your rate opportunities when it comes to renewals. I hope that makes sense. And then consolidation. I guess I jumped the gun a little bit about financial institution consolidation. So mergers and acquisitions might just put people out of certain segments of business lending. All right. So it's not all bad news. I just want people to be aware that it's a lot different than, hey, I'm going to buy a used car personally. I'm going to have 48 months worth of payments. I can pay it off early. And when I get to it, it's mine. All right. Business lending doesn't always work that way. One of the advantages to SBA is the SBA guarantees a certain amortization to where it's fully paid off. So that's another discussion about SBA that you should have with your loan officer. Okay. A lot of people ask me about, well, how long is this going to take? I will tell you that things, even since I've been in this business, have just continued to get faster and faster and faster, to the point now where certain dollar thresholds, you can get answers almost immediately or next day. depending on how small the request is or how good your documentation collection and communication is. But if we look at this chart, typically when we look at loan packets, 1 to 4 weeks to really prep a loan packet. And I say that because it's a very advantageous to talk to score mentors, talk to SBDCs, and try and get a business plan done. If you have a business plan done before you start diving into a loan application packet, that puts you light years ahead. Loan officer review, depending on how busy the loan officer is, how many they might have and the size of the institution, and whether or not that loan packet has to go outside the community, maybe to a different state for review, those kinds of things. But typically a week is not unreasonable. Then the loan committee. I know that when our loan committee gets together, there's always a lot of things that we have to consider right off the bat. Are we going to need to talk to participants? When is the committee going to get together next? How many things are in the queue? Those kinds of things. We try and do those as regularly as possible. Underwriting. So the loan amount will really dictate how long things take in underwriting. And so it's tough to say. Some underwriting can be, like I said, can happen very, very quickly. Other underwriting, especially if there's a lot of environmental factors, those kinds of things take a lot longer. Appraisals, we touched a little bit on what a good loan to values, and then also the dispute process. If you have to go through the dispute process, that usually takes a bit. Environmental. I've seen environmental get done as a questionnaire, and that took less than a week. And I've seen environmental turn into phase 1s and phase 2s once the questionnaire phase is over, and that can take a really long time. And then sometimes there might be some funding, brownfield, what have you, to do reclamations. That has a tendency to put a lot of time on a deal. Then documents, you can get documents overnight. 1 to 3 days really is what I put in there. Title work, depending on if it's a real estate deal and kind of how much is involved in the deal, how many disbursements and how many owners there are, a few weeks for that. And then funding, it's really up to, if everybody's on the same page, if we can sign electronically, great. If there has to be a notary, we just have to get those schedules. If there's other signers in other cities or other states, then we just have to make sure that we get all that done before it's finalized. So a lot of people ask me, well, what goes first? What is it? The cart before the horse or chicken before the egg when I look at these timelines? And here's how I respond. The borrower needs to be comfortable with the timeline and what they think the value of their investment is going to be. So let's say I want a deal to get done in under 30 days. All right. Then I probably would have the expectation that if I need to pay for an appraisal, all those kinds of things, I'm gonna pay those up front. Okay, because I want all of that underwriting, appraisals, I want all that to be working at the exact same time. Now, what's the risk to that? Well, if the deal doesn't get funded, that's gonna be basically a sunk cost. Okay. Now, some people are not on as much of a time crunch. So they say, okay, well, let's go through underwriting. Let's go through the loan committee. Then if we have to do environmental, we'll do that. Then we have to do an appraisal, we'll do that, and then I'll pay for that as it goes, or I'll pay for that in closing. Sometimes you can ask for certain of those things to be paid out of closing funds. And so that just stretches out the timeline. So it really depends on your comfort level on what you might want to invest for the amount of time, the value of the time, so to speak. So I don't think there's any one answer is better than the next. Some people don't want to pay anything to get the answers until the very end, and some people want the speed of, okay, let's get this going so I can get as much information as fast as possible to get it across the finish line. So that's kind of my take on that. All right. Well, I want to be respectful of everyone's time. We've gone about 50 minutes. I know I've spoken a ton. You know, this particular two-part series is usually a full day. I always get a ton of questions thrown at me during sessions. And so I will stay on as long as you want to answer questions out of the chat, or you've got my phone number here on this slide and also my email address. Reach out to me direct. I'll answer, or my team will answer it, or reach out to your SCORE mentor to ask questions sometimes in the middle of the night to be like, oh, I wanted to ask this, or this popped into my head after listening to me ramble on here for a bit. So, I hope though that you just have a better understanding of kind of what happens behind the scenes, kind of behind the lending curtain that you don't deal with every day. And, I always say that there's just as many exceptions as rules. Most of the things we talked about over the last 2 days are a very comprehensive overview of what most financial institutions, how they will handle the process. That doesn't mean that it's going to be the same. They may have less or more. But please, if you have clarifications, reach out. And as always, I always want to give a plug for SCORE. It's a great organization, great volunteers. We've been honored to work with them for many years, and host this series, and also talk with their clients just to kind of give them some thoughts on how we might evaluate a loan. And we would offer that to anyone who sits into these sessions.
Well, Dave, right now we have no open questions. We'll wait a while, but I want to thank you for an incredible set of presentations yesterday and today, and tremendous amount of knowledge. I'd like to call you as the local friendly banker.
Yeah. I like being on the not-for-profit banking a model. I love talking to business owners and people who have great ideas or crazy ideas about growing an empire, that kind of thing. So we appreciate the opportunity.
Dave, I have one question for you. And many of the SCORE clients are nonprofits. How do you look at nonprofits as a borrower?
So that's a popular question. So we first started answering this when it came specifically to churches, right? A lot of churches have trouble because, let's say, there's leadership in churches, but a lot of times they're volunteers, they're not paid. They're not going to sign for the church, so to speak. Sometimes they do, elders, whatever they're called at the church. So we have a separate set of questions about how that business, whether it be a church or any other nonprofit, how it's organized, how it realizes their revenues and on their financial statements, those kinds of things. So as a not-for-profit, we kind of understand how the balance sheets work with not-for-profits. And so I think that credit unions are uniquely positioned to kind of look at not-for-profit requests.
Do you market Comstar to nonprofits?
We try and market Comstar as, that's what we are, but we'll take all packets, right? No matter how big, how small, we'll look at them all.
Okay, here's a question. Okay, can I see that? Came in.
Okay. Do lenders here? I can see it.
Okay.
Okay. So the question is, do lenders rely strictly on the in-house expertise when evaluating the opportunity of a venture? So I would say no, because every single business loan is unique. There's something different about everyone. Now, let's say, for example, you wanted to buy a single family investment property, one property. Well, we've done tons and tons of those. So we have lots of in-house expertise on those. But if you invented a product, all right, we probably have no expertise as to whether or not we think that's a good product or not. But we talked about NAICS codes. We talked about, was it RMA?
Yes.
Those kinds of things. So we will go to those resources and say, hey, how can we evaluate how we think this is going to how this is going to function, you know, for us like it would in other markets, right? So yeah, we don't always have expertises on every single thing. And underwriting, because underwriting companies also have a very diverse set of deals that they look at, more than we do, because they might be dealing with, 40 or 50 financial institutions. They might have some thoughts on it too. Importing a premium commodity. I will tell you that for as far as Comstar goes, we don't have anything in the import business. I'm just, to be transparent. I mean, I would look at any packet, but that's not something that typically we've seen in the past. So I, unfortunately don't have a in-house expertise on that, but we would try and find a source to figure out what the risk is in that application.
Yeah, I would suggest the state of Ohio has some excellent people. I believe they're part of the SBDC network that work on imports and exports and financing those.
Yeah, there's a great, there's SBD offices almost in every major, a lot. I don't know how many there are in Ohio, but there's a bunch. I know there's one right here at Lorain County Community College.
Well, at Cleveland State.
Cleveland State, yep.
And Lakeland Community College and Hispanic business.
Yeah.
But the Cleveland State, I believe, has an import-export officer there related to the SBDC, funded by the state of Ohio.
Yeah.
That's where I would get information on that.
Okay.
I think that's the only question and questions. And want to thank you again, Dave, for doing this. Hopefully we'll do it again later in 2025. And I want to thank the attendees, and please pass the word that take a look at our website. We do about 2 webinars a week, and I'm sure there's subjects that'll interest you. And if you're looking for a mentor, go to www.score.org. And thank you and have a great day.
Thanks, everybody.
Happy holidays.